Good morning. This is Joe Trovato, the mortgage guy and owner of Atlanta Mortgage Advisors, with this week's mortgage interest rate update. Whoa, what a week we've had. We've had historic lows in both the Treasury bonds and in mortgage rates, and it's been volatile to say the least. So, what I would like to talk to you today about is how you, as a home buyer, or a homeowner can take advantage of historically low interest rates. But first, before you can do that, we have to know what's going on in the market. So let's take a look. So the Treasury bond has hit historic lows, right? So the Treasury bond right now, today, the 10-year Treasury bond as it sits is trading at about 92 basis points. That's 0.92%. So historically, mortgage interest rates, the 30-year fixed Fannie Mae rate, typically runs about 2 percentage points or less above this 0.92%. So what that means is that if the Treasuries, you say, hey, Joe, the Treasury's at 0.92%, what's my mortgage interest rate? Shouldn't it be 2.92%? Well, in a normal market, yes, but this is not a normal market. Let's take a look why. Interest rates, mortgage interest rates right now are approaching 4%, 3.9, 3.8. Let's take a look why that is. Okay, if we look at the mortgage-backed securities chart, which is this chart here, shows where mortgage rates hit the rate sheet, where that comes from. So you could see this is the bond price, and as this bond price rises, the interest rates drop. So from 4%, 3.875, all the way down to one. We had one day for about 15 minutes, we had 3% or less. So if you look right here, this is December 26th, the day after Christmas, was the day that the rally started. And you could see the bonds price rose and lockstep with the Treasury bonds. So that correlation during this whole entire time of the mortgage rate being 2% or less above the Treasury held true all through these trading days for the last 3 months until it got to this point. And right here, this is where the Treasury bond hit 1% and fell below, which is historic. It's never happened before. So what happened is that as soon as the Treasury bond hit 1% and fell below, the correlation between the mortgage rate and the Treasury bond, which being 2% above that Treasury bond, that correlation ceased to exist. It no longer exists. So with added uncertainty in the market, what's going on with the coronavirus and the stock market, the bond market, even though mortgage rates should be in a normal market, would be at 2.75, 2.9. The bond market actually sold off. So in 3 trading days, 1, 2, 3, we lost 200 basis points, which is a huge move down. And what that means to mortgage rates, that if you weren't locked in at this point, you probably couldn't get locked in the last 3, 4, 5 trading days. Let me show you why. Because mortgage bankers, right, when they price the rate sheet, they're pricing it off the live price. So here, this chart is a minute-by-minute chart of the mortgage-backed security on Thursday, March 12th. So yesterday, a day before this video is being filmed. So each one of these yellow diamonds represents a price and interest rate change. Each one of these diamonds represents about an eighth in rate, so 0.125% in rate. So from the bottom to the top is, let's see, 1, 2, 3, 4, 5, 6, 7, 8, 8 eighths. So that's a whole percentage point. So what happens when there's this much volatility in the market? If you look here, we had 29 price changes in one trading day. And when that happens, when you have that volatility, the mortgage bankers and the mortgage-backed security guys, they stop taking locks. So if you were trying to lock in your rate this week, or like from Thursday or Friday of last week, it would have been very difficult. So what do? How do we prepare ourselves? Well, number one is, if you're in the market to buy a house, you need to get your loan application into and completed with your mortgage broker. If you are in the hunt for a refinance, which I think everybody should be in this market, lower your rate, lower your term, cash out, restructure your mortgage. Tremendous opportunity. Again, you need to get your mortgage application in with your mortgage broker, get them the documentation they need so that when this volatility comes and the price goes up, you can take advantage of getting the low rate. Because without being prepared and having your application in, the mortgage broker can't lock in your rate. So be prepared. Let's look. We're being prepared for coronavirus and financially with the stock market. Let's be prepared to take advantage with what fruit the market is giving us. And right now, the fruit that the market is giving us is low interest rates. And I would love to help you and your family get put in a better financial position. I'm Joe Trovato, the mortgage guy. Thank you, and have a great day.